The dollar is crashing and the second wave of inflation is coming. Now, I'm sure we've all seen the crazy CPI report in June telling us that inflation has crashed down to 3%. Prices have risen by only 3%, and we're just 100 points away from the promised land. Remember that Powell's objective is to crush inflation down to 2%, and it seems that the fight is almost over, right? Bidenomics seems to be working, and the president is going on a victory tour selling a strong economy to the world. But that is not the reality. I wanted to see through the smoke screen. We need to see through what's being sold to us because this is just the calm before the storm. The battle isn't over yet. The whole world expects the Fed would stop hiking or just hike once more. And this is causing the US dollar to crash. I have bad news, guys, especially if you're American. As the dollar crashes, plus the way the BLS calculates the CPI, we will have a second wave of inflation. It's like one of those aftershocks after an earthquake that you aren't just really prepared for. When inflation rips higher, this is going to take the market by surprise because everyone believes the worst is over. And if we look at how crazy bullish the market has been, this could trigger a big crash that will shock everyone. Now, the Federal Reserve has come out saying that the job isn't done yet. There are still more rate hikes coming. But now the Fed has actually given us a target on which we can actually hang our hats on. Putting up a story from Bloomberg, Wallace says Fed will need 2 more interest rate hikes to contain inflation. According to the Fed governor, there's at least 50 basis points more coming in 2023. However, focus on this next part. 2 more good CPI prints could lead to a September pause. And this is a clear sign that even the Fed doesn't believe the BS inflation reading from June. They need further confirmation. And let me splash cold water on the optimists. From this point, unless there's black magic involved, there's no way CPI can continue to crash below 3%. And it has all to do with the base effect. It's basically how inflation is being measured. The BLS has changed how they compute inflation to just a 12-month comparison. So the awesome 3% inflation print in June is based on a horrific inflation reading 12 months back. That was back in June 2022. Where inflation peaked out at 9.1%. So of course we'll have CPI reading of 3% last month. It's like comparing an explosion, a fire, versus a volcanic eruption. It's still a disaster, but not as bad as 9.1%. And that's why it's insane the market is still rallying. There's only so long you can deny reality because when more rate hikes come, this will come as a shock to the financial system. But guess what? The CPI is not the true measure that Powell is actually looking at. It's all smoke and mirrors that the BLS feeds us to obscure the truth. Now, the Fed's preferred gauge is the core inflation, and this means stripping out the more volatile parts of inflation that includes food and energy. In June, food inflation hit 5.7%, while energy inflation crashed by 16.7%. By stripping these away, you get the inflation of goods and services that are sticky. And this is the true metric that the Federal Reserve is trying to wrestle down to 2%. We have to focus on core or sticky inflation and not just the CPI print. Core inflation today is still at 4.83%, slightly under 5%. Now this isn't good news because inflation is still leaks above 2% and almost at the Fed funds rate. Now higher prices has become sticky and isn't falling as fast as Powell wants. And remember that he wants a stable inflation rate. And he will sacrifice the American economy to reach his target. The US economy still looks very resilient, still looks very strong to Powell. And we know that that isn't the case, but the superficial metrics are still looking extremely good. If we take everything else away, it looks like the economy is still booming. The payrolls are up by over 200,000 jobs in June. Unemployment has fallen back to 3.6%, plus average hourly earnings rose 4.4% year on year. There's a trifecta of good news that Powell will use as an excuse to hike. But there's another big problem out there, and it is the strength of the US dollar. Because the dollar is the reserve currency and everything else is priced in it, it is both a blessing and a curse. In a story by Reuters, dollar buckles on US disinflation signs as the Federal Reserve nears ends of the hiking cycle. Now the dollar just sank to its lowest since April 2022, and why is that? Because investors all believe that the Fed is done with just one more rate hike in 2023 and it's better to chase yield elsewhere. But I think they are all missing the mark. I count 2 more rate hikes and it's thanks to the weakening dollar. Now back in 2022, when the dollar index started to rise well above 110, This was good for domestic inflation back in the United States. Consumers were paying less for imported goods because the dollar was strong, and that put a lid on inflation and prevented prices from going ballistic. But things have essentially reversed. The US dollar is now crashing in value, and that is making imports more expensive for the local US economy. America is the biggest importer in the world. They buy more than China or the entire Eurozone, and this is adding a significant amount of inflationary pressure that we don't see yet. But it is coming, guys. The July and September CPI print will be higher than 3% and will likely stay around there until the end of the year. And don't get me started with core inflation. That metric is going to stay sticky all the way until 2024. Just look at how resilient core inflation is compared to the CPI print. It has gone down by only 1% in 7 months. And that means interest rates, even at 5%, aren't restrictive enough. It isn't effective enough. It has to go up further to crush consumer demand. So we have to prepare for a second wave of inflation coming as soon as September or even July when the base effect wears off. And this means the best bet is still going to be money market funds, funds that invest into short-term bonds and US treasuries. And let's quickly pull up the yield curve. We have this beautiful inversion that will only get steeper. Remember when the Fed hikes rates, they can only affect the short end of the curve. We are talking about the 1 month to 6 month bills. The back end of the curve will get suppressed, yields will continue to stay down, and the yield curve inversion will get worse. And the market knows that higher rates will push the economy off a cliff, so they'll rush to the 10-year treasury bond to lock in their yields. And for us with cash, this is great news because the risk-free rate is about to get even sweeter. We can get a bigger return for doing absolutely nothing. But for the economy, this is terrible. More hikes will push the economy closer towards an official recession. And I want to take some time to address the president's insane Bidenomics plan. I find it extremely asinine that he's trying to run on the economy. And it's quite funny because even mainstream media believes that Bidenomics is pure nonsense. The king of JP Morgan, Jamie Dimon, isn't buying what Joe Biden is selling, warning him to be careful about that. Then you have the Wall Street Journal saying Bidenomics is lacking one big ingredient, which is economics itself. What Biden is doing is simply spending massive sums of money and hoping for a miracle. He is taking his Martian Economics 101 class too seriously. Bidenomics is a combination of horrible deficit spending, misallocation of money, and the crazy use of sanctions. And all this is crippling the US economy, abusing the dollar, and driving the world into recession. And let me use one snapshot to illustrate why Bidenomics will fail. And it's only going to make the inflation crisis even worse, and that is US defense spending. Remember the debt ceiling deal? The US government's $31.4 trillion debt limit has been suspended until 2025. And that means Biden can keep borrowing money to fund his fantasy of a stronger economy. And if we have to pinpoint one industry that won't suffer any cutbacks, it will be defense spending. In fact, it will increase by 11% to nearly $900 billion very soon. And this is insanity. No matter how much power tightens using monetary policy, fiscal policy is out of control. The US government keeps spending and spending, and that will just feed further into the inflation fires. And this is how bad things have gotten. Since the debt limit suspension, over $800 billion have been borrowed into existence, causing the debt to balloon well above $32 trillion. Biden is well on his way to defeating Trump as America's biggest borrower. But here's the problem with excessive deficit spending. You aren't borrowing at 0.5% or 1%. You are now borrowing at 4, 5, or even 6% in some cases. And that is an enormous burden when it comes to interest payments. The issue with defense spending is how inelastic it is. And that means you have to keep borrowing money at high interest rates to fight the Russians and of course to prepare for China, which is the boogeyman. So on one hand, you're still spending borrowed money to power the war machine. You are sucking up tons of commodities and still flooding the economy with money. And on the other hand, the interest payments on the debt is getting higher. Since you're borrowing at 4 or 5% now, the interest paid to bondholders are 2 or even 3 times more than before. And eventually, once the Fed starts to lower rates, the flood of money will be pushed back into the economy and reignite inflation again. Remember that the debt ceiling suspension is only until 2025. So just imagine how big the deficit will become over the next year and a half. And the Fed is trapped. Powell doesn't dare tell his boss to stop spending. The only way forward is to hike interest rates further and keep it there until something in the economy breaks. And if the Federal Reserve is really serious about their 2% inflation target, they can't back down now. They simply can't do it. According to the FedWatch tool, the market is expecting interest rates to stay elevated well into 2024. The majority of people are pricing in 3.5 to 4% interest rates that could last until 2025. We are not going back down to 0% unless the economy suddenly collapses. So what we have now is a time bomb. Can the economy endure 4 to 6% interest rates for the next 18 months before it collapses? And if we listen to the experts, the big boys on Wall Street, a recession is coming. Bank of America believes it is coming in early 2024. Vanguard also believes it has been delayed, shifting their outlook from 2023 to next year. JP Morgan also concurs, saying a global downturn is coming in 2024. And are they right, or is it all hot air? And the issue right now is that the stock market is rallying. The S&P 500 is above 4,400 today, up by 20% from the low in October 2022, and that's just 300 points away from the all-time high. So I understand why many people are calling BS when they hear the word recession. It can't possibly happen, right? However, there's a tiny problem here. There's one indicator that is undefeated, and that is the yield curve. Since 1955, all 10 recessions were preceded by yield curve inversion, and that is what's happening now, where long-term treasury yields are lower than short-term bonds. And this is according to the Federal Reserve, not according to me. But let's put a number on this. What are the chances of a US recession coming? Now, the New York Fed has a very interesting model that calculates the odds of a US recession. They compare the spread between the 3-month and the 10-year treasury yield to get a forecast. And according to the model, the probability of a US recession is 67%. And this means there's a 67% chance that the economy will slip into recession by June 2024. Now, I don't know about you, but the odds aren't great that the economy will be fine. It's basically a Vegas dice roll where you win only 33% of the time. And that's why I'm only 20 to 30% long in stocks. The rest of my money are in money market funds and gold. Now, I know two things, guys. Yields are still going to go up and stay up for quite a bit longer. And I don't believe that the US economy can dodge a recession this time. The Federal Reserve, they are trapped. They can't print money to save the economy. They also can't cut rates yet because Biden is still shuffling money to Ukraine to defeat Putin. And right now, there is a liquidity crisis building that many people aren't really aware of. And this could just choke the life out of the credit markets. And let's recall that Janet Yellen has to raise $1 trillion worth of cash for the US government to spend. So she's still selling a ton of bonds, but the Fed is also deleveraging their own stash of US treasuries as well. This is causing bond yields to spike, which is a big problem, especially when the market believes the banking crisis is over and everything else is safe. Take a look at the reverse repo rate. It is at 5% today, and that is the true risk-free rate because as a bank or fund, you put in money today, you can withdraw it out tomorrow. There's no default risk because the Federal Reserve can simply print money. There's also no liquidity risk because you can take your cash out the very next day. But because Yellen is flooding the market full of treasury bonds, the 3 to 6 month bonds are yielding around 5.4%, much higher than the reverse repo rate. And this is going to drain money away from the facility and lock liquidity up in bonds that will only mature in 1 to 6 months. If we look at the reverse repo facility, this drainage is already happening since the debt ceiling deal. We have gone from $2.2 trillion down to $1.7 trillion. $500 billion have flown away into riskier assets. It has gone into the stock market and US treasuries. And compared to the reverse repo, they all have liquidity risk. Maybe you can sell them off to other buyers, but you'll be taking a big discount. You'll be booking a huge loss if prices crash. And that is the exact same mechanism that caused Silicon Valley Bank to collapse. There are no good endings in this story. Either we encounter a liquidity crisis that breaks the system and the Fed reinflates the bubble, or the economy stays in a stagflation limbo of high interest rates and high inflation. So hang on tight, guys, because we are sitting on a ticking time bomb just waiting to explode. But let me know what you think in the comments below. Will the Fed hike again in July, September, or is inflation actually under control now? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.